your west, looking on the city lights.
We've been trying to get him on for the last 5 minutes. I'm like, we got to start. Sorry that you had to wait. We're going to blame all this on Eric, and he still isn't here yet. Which is the irony is that we just had him on a Zoom, 10 minutes ago.
Right. Like I mean, I don't know. He needs an assistant or something. I don't know what's going on with him.
Well, that's all right. So let's jump right in on a few things. First of all, thank you guys for joining us. I know we have a lot of people in the waiting room, right, Steve? 40, and they're still pouring in. So thank you guys. This is going to be great. It's a great opportunity to get a couple big brains on the show here. And then while we're waiting for Eric, who's obviously very, very skilled CPA, and he has 180 people in his firm, we're going to start off with Mauricio. So welcome back, Mauricio. How are you?
It's always good to be back, and I'm awesome, man. I'm feeling good. I don't know what it is. I don't know what it is. I feel really good though.
Except you're in California.
That's probably why I feel great. It's like,
it's beautiful out, right?
It's not a cloud in the sky, Kenny.
I know. Well, so let's jump right in. Obviously, let's talk a little bit about your, what have you been working on lately? Obviously, people know you primarily with securities, and I know you're also some people may not know is that you're also a maritime lawyer. But let's talk a little bit about some of the things that you're dealing with right now, because I know you're putting together deals all over the world, really. So what are you seeing right now on the legal side?
Yeah, I mean, we're probably from our perspective, we're starting to see a little bit of an uptick again on deal volume. Probably starting in April, May of last year. With all the craziness going on, there was a sort of a halting of the volume, and not only in our business, but just talking to the industry as a whole, there was a lot less people doing deals. They were just, lending was a little bit tighter, didn't know what was going on, our prices going down, people a little bit more hesitant, being a little bit more conservative on the underwriting. But it's kind of stabilized. That lasted for maybe about 6 months until the end of last year. And we're starting to see sort of people getting back into the game and starting to put offers in again and calling our offices for us to put all the offering documents and help them raise the capital. So on one side, that's going on. But on the other side, we're also hearing a lot about, some of these bridge loans are coming due, as you know, Kenny, and that's starting to cause some issues. The interest rates continue to rise, putting a lot of pressure on cash flow and NOI, and the ugly word of cash calls is starting to creep in, and I'm sure that's gonna continue to increase as things progress. And so a lot of moving pieces.
There are, that's for sure. I know, we're looking at tons of deals. Oh, hey, Eric, wake up. How are you? Oh, he doesn't even. Yeah. Anyway, we're gonna move right past you right now, Eric. You got to get your stuff together here. I'm joking. So Mauricio, let's talk about that. We're still seeing a big difference between the seller and the buyer. Their expectation. It's funny. Like, I went to the National Multi-Housing Council almost a little over 2 weeks ago in Vegas. And I haven't been in a while, but I wanted to go because I expected a lot of deal flow. In other words, I really enjoy going to those because all the brokers, this is a multifamily conference, by the way, were there. Almost all of them. A lot of the clients, a lot of the money guys, both on equity and debt. And, it was a big old, it's a great way to basically speed date. We literally had meetings every 30 minutes. I was exhausted. By the time this thing was over. But what I found is that the brokers didn't have a lot of deals. By the way, I've been going to this for, I don't know, maybe 20 years. And it was very interesting. And these are all the top brokers in the country. And what they were talking about were some of these distressed funds. So to your point, I think what we're starting to see are people. Now, when Mauricio talks about bridge loan issues, what that means is that people bought things with these short-term loans, and they're variable. Well, the rates went up, as we all know. The rates have gone up quite a bit since, let's say, March of 2022, so not quite a year, and which increases your mortgage payment, which decreases your cash flow. And I've been getting, Mauricio, a lot of phone calls from people that are running out of cash. They're having some challenges around that. And I think, what do you have to say about that? Oh, he's frozen. Yeah, there he goes. Jeez, I just had a great question there, and he completely. I mean, there's no way I'm going to remember that. I'm just kidding. What did you hear?
I just heard about the bridge loan, and obviously you were starting to explain what the bridge loans are, and and as you, I'm assuming you mentioned, I mean, especially the ones that we're seeing anywhere. There's a lot of these bridge loans that we call the 3, 1, and 1. If that's what you're talking about.
I know exactly what those are. Yeah, which means it's a 3-year term and then 2 1-year extensions. But I think a lot of those lenders are starting to make people impound for the potential new rate increases, right? So what are you seeing inside of that? Because essentially, you imagine there's a lot different in cash flow. You basically can go from positive cash flow to negative cash flow by having these higher mortgage payments, right?
Yeah, and obviously, look, we're involved primarily on the front end of things when people actually acquiring and raising the capital, but we start to get involved on the back end a little bit when people are a little bit concerned about being able to make their mortgage payments or having to, like you mentioned, escrow some additional funds in order to get the new cap rate locked in. And so, we're talking to some clients about cash calls and what that process looks like and what they need to do in order to do a properly structured cash call if they need additional capital to satisfy the lender's requirements.
Yeah, and that, of course, goes to the operating agreement. Eric, welcome, Eric. Hey, by the way, how are you?
Oh, I'm doing great. Just glad I could finally drop in.
I know. My gosh. So, Eric, let's talk about this. So what happens when new money comes in and squeezes down old money? Because that's essentially what's going to happen, right? The cash call comes from the general partner, additional limited partners, or some other strategic partner.
Right.
And all of a sudden, they potentially are going to be in some different positions, right?
Yeah, you always have great questions, Ken. So this is where planning ahead becomes so critical on all the things that you don't want to think about happening when you're putting together an operating agreement. And Mauricio deals with this also just as much as me. But you notice like a lot of people either there's different ways you can do cash calls, and every agreement is different. So sometimes if you're syndicating a deal, maybe the general partner is the one that is responsible for putting up the cash. Or maybe if you've got a group of investors together, they're all responsible. But just because you put something in the operating agreement on who's responsible for the cash call, then you have the next thing to think about, which is what if someone who's responsible for the cash call doesn't actually have the funds or want to put more into the deal? And then what's going to happen? And so I've seen this before where they didn't contemplate that it's in the agreement, and it can happen for all kinds of reasons. It's either because of debt, like what we're seeing now. It could be because of wanting to expand the property. Like I did it with a hotel. They wanted to add a whole bunch of rooms and do a complete makeover, and they needed capital from somewhere. And so you have to determine, does that mean you're going to penalize someone for not contributing? In other words, are you going to dilute their interest? And if so, how much are you going to dilute it? Or are you going to treat the additional capital as a loan from your partners? Are you going to get it from a third party lender or individual? So there's all kinds of considerations, and every deal is going to be negotiated differently. But hopefully your agreement will have something in writing on what the idea of how that's going to work, because the last place you want to be is you need the capital now, and you can't get any of the partners to agree on what's going to happen when someone's not putting up the cash.
Yeah. Go ahead. Sorry,
A
Mark.
quick observation there. First of all, your operating agreement should have a section on capital calls, and if you don't, you should probably fire your lawyer. What's interesting though is I think a lot of sponsors review that section and they get concerned or they're upset that the cash call provisions generally are not mandatory, meaning the investors aren't required legally to provide the cash call. And the reason for that is because on the front end, when you're trying to raise the money, investors don't want to be in a situation where they're going to write you a $100,000 check and then there's a chance that you may have to contribute additional capital. That's not very attractive on the front end. So it makes it a lot easier to raise the capital when there are no mandatory cash calls. And that's usually the sort of the default position. But to Eric's point, when there is a cash call, now we got to figure out, okay, we made the decision that we need more money. We're going to go out to the investors. But to your point, Eric, what happens if they don't have the money, or maybe they have the money, they just don't want to put more money in there? There should be provisions in there. Generally, we have the first line of defense. Obviously, always the first line of defense is the sponsor comes in and makes a loan to the company and there's an interest rate. But if somebody doesn't provide the cash call, usually somebody either has the option to loan the money and basically on behalf of the person not making the cash call, and then they put a lien on their shares so that when there is some cash flow coming in the future, that goes towards the person who let the money, instead of the person who didn't want to do the cash call. And then if we still can't raise money that way, then you've got to go to the market and you've got to raise additional capital, and that will dilute your position if you're not making the cash call. And that's all detailed in the operating agreement. There should be a section called cash calls or additional capital contribution, something like that should be in that operating agreement. That's the first place you need to go if you're thinking about doing a cash call.
So really, really good points here. So one of the things I was seeing, in the last few years is different classes of investor. So, so in our deals, as you guys know, we just have a GP and LP and everybody's treated the same. But I started to see different classes. So I started to see A class, B class. I also started seeing in other deals preferred and common. So could you talk about the two differences? Because I think this is a very important point, because I heard last week that there was some litigation that went on and they actually won. And there had been somebody that had come in on a preferred side later and basically took the whole deal. And so can you walk through the different classes? Because I think it's just good education when people are reading that they understand how they fit in that waterfall.
Yeah, that's a great point, because, in the good old days, Kenny, which you're a part of the good old days, it used to just be, investor class and sponsor class. Yep. And over the years, we've definitely seen a split of those investor classes. So usually class A and B and C, or maybe A1, A2, A3. There's two reasons for that, or two scenarios. One of them is simply they want to encourage people to provide more capital. And so they'll give preferential treatment to people who put in more money. So for example, your investment might be a $50,000 investment. That's your minimum. But if you put in $100,000, you're going to get more. I think I froze.
No, you're good. You're good on our side. Oh, maybe not.
Oh, not now, I guess. Well,
I think we got to wire him some money for a new computer. What do you think?
Right.
So, Eric, why don't you pick up on this? Because I know you've seen some of this.
Yeah. So the scenario I'm thinking of that's really common is when you have, because this was common the last few years, it would be, for example, you had a lender and you had equity, but you didn't have quite enough of loan. You had someone that wanted to lend to you, but they didn't want to be an equity member. And the problem was you had a first loan, and so that lender didn't want anyone else having, a piece of the collateral. So what they would do is sometimes they even call it a financial member. And this financial member really was kind of like a pref. So they would say, okay, if you invested $1 million, we're essentially kind of treating it like a loan. It's not, but we're going to treat it that way in the sense that we're going to pay you 8% first, or whatever it is, before we pay any of our equity investors, and we're going to pay our first loan, and then we'll pay all the equity members. So what ends up happening in the capital stack is the lender still has the property secured, and maybe some guarantees. But then that financial member, they're going to be the first ones to get money out above all the other equity members. So they're in a way, they're not a second deed of trust, but they are a second in position in that capital stack before everyone else, because their intent really was they wanted to be a lender. They just couldn't collateralize the loan because of the other lender requirements. That was a really common scenario that I saw a lot of times. And then now I see Mauricio's back, so I'll turn it back to Mauricio. I was just filling in for you.
I know, I heard, and I'm afraid to speak because I may get frozen out. But yeah, so that's the second scenario that comes up is people want almost like a mezz finance, so that in between equity and the debt. But lenders don't like it that you put in a second position, and that's just not going to work. And so even though technically you are equity, you really owned 0.1% or whatever, but you got your pref, you got a 10% return. It was sort of it acted very similar to a loan. In fact, for all intents and purposes, it's a loan. Just legally speaking, you own shares in the company, but that didn't really matter. You weren't going to be part of the upside. You were just going to get your 10%, and it was a preferential position, meaning obviously the bank got paid first, but before the equity got paid, that Class A would first get their 10% or 12% or 8% first. But on the flip side, once you sold and made $1 bazillion, that pref didn't get any of that upside. They just got their 10 or 12%. So it really was I don't want to say a disguise. It wasn't anything, illegal or anything, but it was basically a loan that was in the form of an equity, which the only reason it makes sense is because lenders don't like second positions with their deeds. So that's the second scenario that I was about to get to. But the first one was just, you've got to treat all your investors the same. So when you want to treat investors differently, you start creating separate classes. So if you want to give somebody a better return, a better pref, or maybe instead of an 80-20, it's a 70-30 or what have you, that's when you start creating and splitting these classes up to incentivize people to write you bigger checks. Hey, if you write me a $500,000 check instead of giving me a $50,000 check, well, I'll give you a 10% return, preferred return, as opposed to an 8%. It's just an incentive to treat different classes slightly differently.
It's a good point. So I just want to summarize what you guys said for everybody that's watching. So there's what's called a capital stack. That's all the money. That's just money. You can call it debt, equity. You can call it whatever you want. The first one is typically a first deed of trust or debt. And that's typically what gets the collateral for the property. So that's, let's say, 65% LTV as an example. Then after that, there's the other classes, right? So there's what's called a waterfall. So the debt gets paid first always, and then the next one, then the next one, then the next one. So that's the waterfall as it cascades down, let's say. So they all might have different pricing. So even though it might be called debt, it might be called equity, it might be called a financial partner, it might be called mezz, whatever. It just is money in between other money. And so as that gets whittled down, I think you have to understand where you are personally. So where did you come in? So if you came in at the tail end of that capital stack, and we're getting into these times where these cap rates are actually declining the valuations, so we're seeing cap rates go up. There might not be money left at the end in these, let's say, lower, investment tiers, right? So call it the C tier. So if A gets the preferred money, let's say $1 million and up, B gets $250 and up, and then maybe C gets something else, depending on where all that waterfall falls, you may or may not be in the money. And I think that's what I wanted to talk about today is, as some of these bridge loans, the loan maturities, some of these big financial partners, they're saying, hey, we want out, we want to exit. Then, all of a sudden, or maybe it gets recapitalized, which is actually the more important issue. Where would that money come in? Let's say you got a different GP and LP structure, like the old traditional structure, and something needs, let's say, $2, $3, $4, $5 million. How would that money come in, Mauricio, and how would it be treated?
Yeah, again, you got to go back to your operating agreement because every agreement's slightly different and the operating agreement is going to govern. But usually the ones we have, for example, once you've exhausted the avenue of getting existing members to contribute capital, and if somebody doesn't contribute, having another member contribute on their behalf, then it's up to the manager and they can decide to go out and get maybe a loan from a third party, and they come in as a loan, obviously ahead of everyone. Or maybe somebody comes in with equity. And at that point, it's at the manager's discretion because they've exhausted their sort of traditional cash call per the operating agreement. And hey, the members are not willing to or unable to give the capital. We've got to go to the markets right now. And whether it's going to be a loan or the equity, whatever's in the best interest of the company, we're going to negotiate what we can. And it really just depends on what the market conditions are and how hard or easy it is to get. I mean, think about it. If you're having issues, you're not in the best negotiating position, right, to go ask for money. I mean, there's a problem with the deal. And so the terms are going to be not very pleasant if a private equity group comes in or even an individual. They're going to want great terms and be completely protected. And they're going to want to be first in line, after the bank, obviously.
Yeah, this is where the shark's in the water, right? Blood in the water.
Right.
What was that, Eric?
Yeah, that's a good point because it's almost like if it's not coming from the existing partners, then it's really a renegotiation of the deal. So you may have equity partners that are getting a certain pref and maybe the value, if you were to value the underlying assets and you were to say, okay, if we actually sold the asset, your interest would be worth X. Well, when you go out and if someone wants out, maybe they're taking a 40% haircut on that value for someone to come in and take them out. Or maybe they're renegotiating the operating agreement when they come in, and maybe the pref is changing. In other words, if there's a preferred return where the equity members are getting a certain percentage before the general partner, maybe that's being renegotiated at that time. So that happens all the time, but the discounts are probably one of the biggest forms. If it's an equity member coming in, not a loan, then you're just renegotiating how much is someone going to pay you for your interest so you can get out of this deal.
Right. Yeah. So I guess said another way, the best scenario would be a loan that would be behind everybody. That would be the best scenario. Then there would be another scenario that would be a loan in front of everybody. And then there could also be an equity in front of everybody. And there could even be a dilution. So I think there's a lot of different scenarios, and there's probably more. But, those are all potential issues as we're heading into, these uncertain times. I think, if a syndicator is in a position where they have to sell or they have to, let's say, get a new loan, for example, or their bridge loan is up, then they could be this could be something that's forced, right, based on whatever the market is willing to pay at the time.
Right, exactly. Yeah, you don't have a lot of options sometimes if you're running short and if you're the debt. I mean, that's going to be a big issue, replacing the debt now with the interest rates where they are. If you underwrote a deal 2 years ago with the bridge loan where interest rates were one thing, and now you're trying to go to the market and replace that debt, now your deal looks completely different.
Even 1 year ago.
So,
right.
Yeah, even 1 year ago. Yeah.
I know, it's surprising. I mean, just February of 2022, we were all good to go and people were crushing it. And then I think March was the first rate increase. As inflation started going up. So we're going to jump to a few questions here. I know Mauricio's having a tough time. He got to do computer, guys. So you got to give him some crap, by the way. Steve, let's jump to a couple questions. Or do you have time?
His mic's not working. So this is Jerry, the technical director. So we're going to run to a question for Eric.
Great.
And
Eric,
we apologize
for you.
For Mauricio. We have a question for Eric. Due to the TCJA, accountant said...
I need income 4 out of 5 years. Therefore, last year she did not apply any of my expenses and showed my income, all income. Your opinion, could I have used expenses? Do you see that question?
So I'm not 100% sure what they're referencing, but I'm going to try and give it an attack. What I think they're probably talking about is maybe the hobby loss rules, because the hobby loss rules, those basically, the IRS doesn't want you to deduct things for if you're just going out and you're doing something without the real intent of driving business and creating income. And so they create these hobby loss rules, which can apply to a real business too. But basically, it says that if you don't make money for a number of years and you don't have any gross income from it, then it looks like you're not doing it with the intent to profit. And therefore, we're not going to allow you to take any deductions. And so the IRS automatically assumes if you have losses for many years in a row, that it is a hobby. And so your job, basically, the burden is on the taxpayer to prove that no, it's not a hobby, that you were doing it for profit. And so certain things that you can do to show that is, for one, having a legal entity organized, so it looks like, okay, I set up a legal entity and I'm running everything through it. I have a bank account for that legal entity. I'm keeping books and records for this entity. I'm showing that I'm spending X amount of time doing this. Or even it's easier if you don't have another large source of income to show, okay, my only source of income is going to be this. So maybe you're married and you have one that's the breadwinner right now, and you're starting this business, and that's where you're spending all your time, and it's not profitable yet, but clearly you're doing it with the intent for a profit at some point. It's just not there. So those are some ways you can try and get around that. But otherwise, there is a presumption by the IRS that that you are in a hobby if you're not actually generating profit. They just don't want you creating deductions you're not entitled to, essentially.
And this is a little confusing to me, actually. It's a great question. There's a professional designation as well. So does that have anything to do with this? Because I know, I think, you have to spend 50% of your time, I think, is the test.
So you're actually that's another threshold. So you're talking about the material participation rules. So you're talking about whether it's passive or active, which is a little different from hobby loss rules.
Okay.
So hobby loss rules more have to deal with the IRS is saying this isn't a legitimate business. You can't deduct this because we don't believe you're trying to make a profit. Versus material participation and passive is more, the IRS, okay, recognizes this is a business, but we don't think that you are spending time doing it. You may be generating a profit or have the intent to generate a profit, but you're not the active one driving the activities. Maybe someone else is, and you're just a limited partner. And so then that is a separate category which you can carry those losses over, versus the hobby loss rules, you don't get them at all. If you can't deduct them now, you don't get them later if the IRS says it's a hobby.
I see. Good. Thank you. Hopefully that answered your question. Thank you. Great one.
All right, so we've got a couple more questions here, both related to like 20-year-olds. So this first one is, should a 20-year-old who gets into real estate do owner finance? And also, they also wanted to know, how do you do bonus depreciation? So that's pretty aggressive.
So can you see that? Should a 20-year-old who gets into real estate do owner finance, meaning go out and look for owners who are old or tired? That's us, by the way, that most likely pay off their property. Also, can you do bonus depreciation? So it's funny. Yesterday, we had a very sharp kid, 23 years old, in here, and he was 19, and he got the owner to do an owner finance, literally. That was his first deal. So, Eric, you want to chat about this one?
Yeah, definitely. So, I mean, I think I'll address two parts, because there's two parts. There's the bonus depreciation, and there's the owner finance piece. In my experience, which is very limited, I do some real estate. I've been doing it for over 10 years now, but my first choice is usually bank financing, because you can usually get it longer and you can usually get it for lower rates. So when you can't do that, now you're going into the next categories, and owner financing is probably the next step. because they're trying to unload it. They're motivated to get rid of it. So the only question is, what they're concerned about are two things for the most part. One, what are the taxes that they're going to have to pay when they sell this asset that maybe they've had for many, many years, especially if they're getting out because they're old and tired, right? They're retiring. They may have held onto this asset for 20, 30 years. So there's probably a lot of appreciation. They've probably taken a lot of depreciation on it. So they may have a very low basis. And so one way to try and help your case if you want owner financing is if they do owner financing from an IRS perspective, it's an installment sale. And so that means that they will recognize the gain over time as the payments are made instead of all at once. So it spreads out the tax bill, which potentially lowers the rate they're paying. So that means potentially lowers the overall tax if they're spreading it out over many years and staying in a lower tax bracket. And then the other thing they're concerned about, obviously, is whether you're going to pay the loan. That's really, a big piece of convincing them, because you're probably not getting bank financing or traditional financing because you can't qualify or something else. So you're having to convince them that you can make good on the loan. But as long as you can, we were just talking about, bridge financing and things. A lot of owners that are doing seller carrybacks, my experience, that's not necessarily their first choice. It helps with the tax bill, but a lot of times they're not in the business of loaning. They're really just trying to unload the property. And so your terms are going to be shorter a lot of times. Like I remember the first owner financing deal I did, I had 18 months. And so I had to find bank financing or some other kind of financing within 18 months. So that gave me time to increase the rent, get everything looking good to a lender, show that it was a good property. So that's one of the concerns, is making sure you have enough lead time and you're actually going to be able to refinance it, especially in an environment where interest rates are rising. And then the second part of the question was the bonus depreciation. So it depends on what kind of property you're talking about, whether this is residential or a commercial property. But you're going to start off with just the typical depreciable life. You can't separate out the components just by picking numbers and allocating your purchase price. It's either 27.5 if it's residential, or it's 39 years if it's commercial. If the price is high enough, how you would take advantage of bonus most of the time on existing assets. So if it's a multifamily project, you've got appliances and carpeting and things that you could, in theory, take bonus on. You have to do a cost segregation study, which is getting an engineer and a CPA in there to break down, to actually value those different components for you, so the IRS respects it, and then taking the bonus. You can take bonus going forward on certain improvements. So if you bought multifamily and you're having to replace appliances or replace carpeting in there, then you can take bonus on those new purchases. But without a cost seg, you can't on the existing assets themselves. So hopefully that answers the question.
I think, Kenny, can I just add one thing?
Yeah.
One of the things I think people forget when they're doing sort of, especially if you're 19 or 20 year olds, but don't forget about IRA money, right? I mean, there's a lot of people out there that don't know that they can actually take their IRA money and lend it to you. And especially if they're a little bit uncertain about the stock market these days, it may even be a relative or a friend that may have not even realize they've got money that they can access. And if they can loan it to you at 10%, and secured in first position, super secured, that's a source of capital that I think is often overlooked.
That's a good point. And I think, it's funny, that young man that was in here, he was saying that the guy he bought it from didn't want to sell the property and have to realize all that capital gain. And he also didn't want his kids to have to deal with the management. And so what he did was owner financing and had the payments through the installment, like Eric said, to the kids' trusts. And that worked really well because they got a reoccurring, they would get the property back, of course, if he defaulted. But he was getting they were getting these reoccurring payments. He doesn't have to manage, doesn't have to mess around with the property at all, and the management and all the things associated with that because they had never been involved before. So that's a really astute question, good one. And also on the IRA, I believe they have to move it to a self-directed first. Is that correct?
100%. Yeah. So if you've got it in a traditional IRA, that's not going to work. But it's not complicated at all to open up what's called a self-directed IRA, where you are the one that's actually directing the IRA and what investments you make. Because the traditional IRAs, they only, the broker that you're working with, they only get paid if there's a commission. And so they're not really in the business of, even though it's legal for them to invest in real estate or precious metals or oil and gas or syndications even. We have a lot of clients who use IRA money for their syndication. Those are all legal. The challenge is from the traditional IRA, the broker that's helping you out, they don't get paid on those things. They only get paid if you buy a stock or a mutual fund. And so a lot of times that's what you're limited to in a traditional IRA. But if you go to and there's several of them, if you go to a self-directed transfer, you open an account in a self-directed IRA, transfer your money from your traditional to your self-directed, you can then dictate to the IRA custodian, hey, IRA custodian, I want you to make a loan to Eric at 10%. Here's the note, sign it. Or, hey, I want you to go buy precious metals or real estate or whatever it is. And that's something that a lot of people don't know about. I really think it's worth getting educated on that. If you have an IRA and if you are looking for money, that's a good source to educate those folks as to that option and maybe even help them walk them through that process, because then ultimately they're going to have access to that capital that that person didn't even know they thought they couldn't even touch until they were 65.
Yeah, it's a huge up and coming industry, as we all know. And just think about this, guys. Like your employer traditionally has a 401k that they're matching, let's say, and you're plugging money away with some financial broker, whoever it is. And you don't realize that you do have options, and you do. You literally can take that money and move it from that financial advisor to a self-directed, and it is literally self-directed. So it's like moving it to your own bank account and then doing what you want with it. And most of the world is set up. I know in Australia it's called the superannuation, and in Canada it's called the retirement savings plan, the RSP, and you have that option there. But in the U.S., it's basically your 401k is traditionally managed by Wall Street, and so there's you should know that, because what also happens is there's an educational component. Like, I guarantee you, my brother and my sister do not know anything about a self-directed IRA. I guarantee it. They've been taught to just have that money go into a 401k through their employers, let's say, forever. And it's built and built and built and built, and it's been managed by their financial advisor. If they knew that, they could use that money, move it to self-directed, and then basically do what you want with it. You do have to keep it in the self-directed name, because I've done this where you move it and then it's, let's say it's Ken McElroy self-directed IRA. That money goes in that way, comes back out that way. So you can't really go to you personally because it's still sitting in this retirement piece, right?
Yeah, correct. So the same limitations. So the limitations are more on who you can deal with, the self-dealing limitation. So I can't lend money to my brother or my dad or my spouse or make an investment. I can't buy a piece of property and live in it myself. So it's got to be separate and distinct. But there are very few investments that you cannot make, which generally don't even apply to us. Like, you can't invest in banks or collectibles. Is a bummer for me because I'm a huge wine guy. So I'd love to be able to use when I had an IRA to buy wine and do my collection. So I can't do that. But other than that, most investments that you're thinking of that potentially doing, there's money there for you to access. And again, I think from an investor standpoint, I mean, I remember you and I, Kenny, talking about this years ago, that if we had to do this all over again and we were 19 or 20, just doing, back then it was doing seminars on this, or now maybe starting a podcast or doing some content about this idea of educating people, that'll open up and unlock a ton of capital, because a lot of people don't want to have some people do, but a lot of people don't want to have their money locked into the stock market, and they would love to go lend it on a piece of property, or even actually go buy a single family residence and rent it out and get the rental income. And again, the rental income goes to your custodian, to your IRA. It doesn't come to you, but it goes into your IRA and it continues to grow, inside that IRA. And, for many people, it's a better option.
You got it. It is absolutely right. It's a really, really good question and a good angle we took there. Jerry, what else you got?
So we have Anthem asking about capital calls and what do you tell investors faced with capital calls?
There you go. Right up your alley. Okay. That's great.
It's almost a softball, but I'm actually I usually quote Kenny, and it's funny that Kenny's here, but Kenny many, many years ago said something that was really impactful, not only for me, but everybody that was in the room. And you talked about communication builds trust. That was kind of your tagline. And so when things aren't going well and there's a capital call or the lender's reaching out to you, that's the time to triple down, quadruple down on your communication with your investors. It's not the time for you to bury your head in the sand and ignore investors. As soon as you start hearing bad news, start communicating that with your investors. Most investors understand, especially if you're dealing with accredited investors, they get it. But the worst thing you could do is just ignore their calls, or if you're not giving distributions, give an explanation. So step one would be to sort of quadruple your level of communication with your investors, not stick your head in the sand. And then obviously from then on, it's part of that communication is like, hey, it looks like we may need some additional capital. And typically clients will put together a conference call, a Zoom call or whatever with the investors and go through, as we mentioned earlier, the operating agreement and let them know, hey, here's the procedure for a cash call. The manager has decided that we do need $500,000 or $300,000. There's 30 investors. That means everybody's got to put in $10,000, and you just educate them through the process of what's outlined in the operating agreement, which is going to dictate how this cash call procedure is actually going to go forward. But communication with the investors about that provision and what's going on is going to make your life 1,000 times easier.
Yeah, I've been through this before, guys, and I'm telling you, like when people invest, they get the PPM, they get the business plan, but a lot of times, they're overwhelming. Those documents can be overwhelming for people, and so you might be all buttoned up and correct on the documentation side. I'm not suggesting that you aren't, but if something's going on, then you better be putting that in writing and letting people know. It's really, really, really important that like we already put a letter out on rate caps that are expiring in 2024. So as our company, and we're already looking at all of those. We don't know what rates are going to be. We don't know what cap rates are going to be. We don't know any of that. But that's how far out we are, and you should be doing the same thing. It's communication's key, and also that is what your job is. Your job is to manage that asset and manage that investment, and have a plan. And things don't always go the way you think they're going to go in the business plan. And that is what the quarterly investor reports are for, in my opinion. They're not fluff, they have to be, have some teeth in them, right?
Yeah, 100%. And I mean, that I know that piece of advice was so valuable, not only to me, but a lot of my clients that when these issues happen, they just double down on the communication. And I love the fact that you're doing it early. I mean, as soon as that first potential bad news comes in, let the investors know so it's not a huge surprise. Oh, wait, we've missed distributions for 2 months in a row. I wonder what's going on. They should know that way ahead of time, that something's going on. Cash flow is getting a little tight. Lenders breathing down my neck. Whatever's going on, the market's shifting, my rates, my bridge loans expiring, all that stuff. The minute you hear about it, put that in the quarterly report. And then I think, again, it's not even quarterly reports at that point. It might be monthly calls or even weekly, or as needed if the situation warrants it.
Yep. Yeah. And yeah, it's okay, guys. Like, if you're just being palms up and you have a plan, that's okay. You may not even have all the answers, but you really, really need to be transparent in that regard. So another really, really good question. Steve, Jerry, what else you got?
We've got Daily Smelly, which is a great name. Is worried about, they're a small landlord. They're worried about rent control and what they can do to prepare.
Oh, how seriously should mom and pop landlords take their recent talk about nationwide rent control? Well, I'll take this one real quick. I'd love to hear your guys. So I'm really researching this very, very strongly. First of all, you take a look at there's I did a video on this specific issue. There's different variations of rent control. There's rent caps. There's all kinds of things going on. And you got to think about the what's happening in that particular area. And the big issue is I don't believe that you're going to see nationwide rent control. It comes up a lot, because that's kind of the whole point between the states and federally and how all that works. It's the Fed, I guess they could try, but they're going to get a whole heck of a lot of pushback. But not every place needs it either. And so what we're starting to see is these different municipalities pop up with rent caps and rent control. So like California, Oregon, of course, has rent control. And then you have little places like St. Paul. I think it's St. Paul, Minnesota has a rent cap, which means that you can only raise your rent 3%. What's really happening, though, if you think about it, is we're starting to see expenses go up. So we're seeing utilities go up. We're seeing property taxes go up. We're seeing labor go up. We're seeing insurance costs go up. We're seeing property, I think I already said property tax, but so the inflation that's hitting everybody individually is also hitting properties. And so, we're seeing our expenses go up. So when a municipality caps your income and your expenses are go up, then what happens is capital redirects. Capital goes where it's treated best. So I was talking to a lender, and I said, what are you seeing? He said, well, we're staying out of any of the rent control states or cities because, why would you invest either debt or equity in those markets with those kinds of controls? I understand it. I do. I understand that, this thing can potentially get out of hand, and that we've had some high rent growth, and I do understand that the quandary everyone's in around this. The cure is supply. That's the cure. The population's growing, and migration patterns are changing everything. And the one thing, the big offset is whenever I bought a building and a new one went up next to me, all of a sudden there were concessions and flat rent. That's how it is. So supply, actually, believe it or not, is a big factor, and this country is severely undersupplied. So do you guys have any comments on rent control or what you guys are seeing with that?
Well, I'm wondering, if you talk about supply being the solution, and if you think about it from a landlord or an investor standpoint, if you have a place with rent control and then you have a place without rent control, you're probably not going to build or buy in the one that has rent control. So
Bingo.
Then it makes the problem even worse, right?
That's my point. If you look at rent control, just the history, just Google it, you'll see it hasn't worked. There are ways to do this. There are ways to provide affordable housing, and I think it's through private-public partnerships, or PPP, which is where the city, the county, the state partners with people, developers typically, and they have some low-income components to it, et cetera, et cetera, et cetera. And it can really, really get bad. And think about some of these big, expensive urban areas. I remember going and looking in San Francisco years ago, and one of the things that I was alarmed about was, think about the nurses, the teachers, the police, fire. They can't live in downtown San Francisco because the prices are so much. So what was happening is the response times, the ambulance, the fire, the police, were so long. So, this affordability component is a big deal, and it's looked at everywhere. And there are really, really good solutions that I've seen around the country work. And but rent control hasn't seemed to be it. So I don't think there's going to be a nationwide rent control, but I do think, we really got to take a look at who your local politician is, because they're talking about it now, and we're seeing it in Arizona at different cities, and we're even hearing the governor talk about it. But the governor is actually talking about affordable housing, which is better. How do we provide affordable housing, and how do we do that? And that I think could be potentially really proactive.
Yeah, and just as a personal experience, obviously, I'm in the great state of California, which, as you can imagine. So there's a lot of counties that have rent control. I'm down here in Orange County, and we're part of that sort of California part. I'm actually renting right now, and there's a cap on 5% rent increases plus an adjustment, a living expense adjustment. But guess what? We have one of the largest affordability problems around. We have the most homeless people in the country, and it's because, like to Eric's point, to both of your points, people don't want to invest. Why would you come buy an investment property or an apartment building or multifamily here in California when you have these risks of not being able to raise the rent while your expenses go up? Not to mention not to get too political, but all the regulations just to be able to build a new house. Everything's got to be, all these regulations just increase the cost of construction, making a starter home really, really expensive. And so all of those are contributing to this affordability issue. And I feel like California is in the front and center of the biggest issue with affordability. I don't know how people are still sticking around here.
Yeah. I know it's really, really bad. Homelessness is out of control there. And I was just looking at, I think it's Newsom. Gavin Newsom is a governor there. He's got somewhere between $2 and $3 billion to actually spend on the homelessness issue. And by the way, that's not to solve it. That's actually just to, maintain it. So there's quite a bit going on. I mean, I'm from Seattle. I've seen in Portland. There's affordability issues for sure. And I did a whole video on homelessness, just recently, and it's a big deal. But rent control is not it, in my opinion. So.
Getting lots of good questions here, so let's see if we can. I'm going to give.
We're going to stay a little longer because Mauricio was in and out, man. I don't know, Mauricio. And Eric, you were AWOL for another 10, so I think we owe it to everybody.
So the first one's I guess Mauricio would be a good one for this. DCAP wants to know, do you have to be a accredited investor to loan someone money through your self-directed IRA?
That's a great question. And the issue of, and I'm thinking, I've been planning on doing a video on this for so long, but the question really comes up is a loan a security? It's really the main issue, because if it's a security, then you have all these issues where it doesn't make any sense. Like if somebody wants, like to your example, if you want to loan somebody $100,000 or $200,000, it doesn't make sense for somebody to spend the time and money to put together a $15,000, $20,000, $25,000 private placement memorandum, all the compliance costs. And so the issue of whether a promissory note is a security or not is not a super simple one. The easiest way to sort of do that is if you can secure the loan with real estate, then that's one way to kind of get outside of that, get caught in the net of being a security. So a loan secured so if you're loaning for a flip or something and you want to be a hard money lender, you can loan somebody the money and secure it in first position. That's likely not a security. Or actually any loan that's less than 9 months. If I lend you money and you give it back to me, or the loan agreement specifically says you're going to give me the money back, it's due in 6 months, 7 months, 8 months, that's not going to be security. But that's the only time, to specifically your question, the only time the issue of an accredited investor comes up. Because otherwise, if it's not a security, then it doesn't really matter whether you're accredited or non-accredited. If you want to loan me money, you can loan me money. So the real question you want to ask yourself is, am I unknowingly issuing somebody a security, even though you're just thinking I'm just loaning somebody? Think about it. A loan is really a bond. It's a security. And if you look at the definition of a security, it's the first thing that pops up: bond or note. So you got to be super careful, but it's not as simple as you would think. And I've been having a hard time trying to figure out how to explain it in sort of simple terms, because unless it's a 9 month or less loan, or it's a loan secured in first position, then it just goes off the rails, and you got to go through these 5-point factors and looking at all these things, which just makes it super, super complicated.
Well, let's do a video on that one, man. Come on.
I need, yeah, it's on the list. It's in queue.
Awesome. What else you guys
All
got?
right, the next one's from KitKat, and it's primarily to Eric. But see if he can answer this pretty quickly. If you sell a property and got hit with capital gains, but you use those funds to buy another property without a 1031 exchange, can you amend that cost with a cost segregation? Yes or no? I'm just kidding.
Yes or no, that's all I get.
What?
But
Come on, Jerry.
It knows it's always, it depends. There's always more.
Oh my gosh.
I'll answer it quick though. So if you don't do a 1031, this is a good strategy. So you're not having to amend anything, but what you're doing is you're recognizing a gain on the property you sold, and then the property you purchased, you would do a cost segregation study and try and wipe out as much of that gain as possible. So you can do that. I would just also consider the long-term plan and whether you maybe want to save those deductions when you have ordinary income, because the capital gain is going to be at a lower rate. So if you're going to have income later, but it's going to be ordinary, you might want to use that cost segregation study to offset that higher taxed income.
So so what you're saying is that those tax rates are different. So you have to consider that as well. Because one of the things, guys, I learned from Eric is that you don't have to use your cost segregations or bonus in the year you buy it. You can actually put it as a tool in your tool belt, and you could pull it out in year 3, 4, 5, and you can use it at different times as part of your overall tax planning, right?
That's exactly right. A lot of people miss that. And the other awesome thing about it is that it can be awesome. Right now it is, because you use the depreciation rules in effect when you purchase the property. So we have 100% bonus depreciation for 2022, but not for 2023. So if you bought a property in 2022, but you choose not to implement a cost seg for that tax year, you could do it later, say 2 years down the line, and when bonus is lower, you can actually take advantage of the 100% bonus because you purchased the property in 2022 when we had 100% bonus. So some people think that if they delay it, they may be losing out on those tax benefits, which isn't the case.
Yeah, that's a good point. All right, Jerry, what else you got?
Do the luck show. I'm not sure exactly what they're asking here. As an LP, if you do not pay the capital call, can a company disqualify you from receiving ROI? So I'm not sure. Maybe that's Ken.
I think I get it. So there are provisions again, you've got to look at your operating agreement, but there are sometimes provisions where, and I think I referenced it earlier, where if you fail to, let's say there's a cash call and I'm supposed to give $3,000. Let me give you an exact example. There's a cash call. I'm supposed to provide a check for $3,000. I don't have $3,000, or I don't want to pay $3,000. There's sometimes provisions in the operating agreement that allows Eric, for example, to make that $3,000 cash call on my behalf in the form of kind of a loan. So it's almost like he's loaning me $3,000 to make the cash call at some ridiculous interest rate, 18%, 15%, whatever the maximum is by law. And so when there's distributions, I think we said ROI, when future distributions are coming, instead of those distributions coming to me, they first have to go to Eric to pay off the interest on the $3,000 loan, and then obviously paying back for the $3,000 capital call. That's the scenario where some of that distribution would be diverted if there's sort of a loan. It's not really one that you would willingly wanted to do, but somebody's basically loaning you the money to do the cash call and then putting a lien on your shares. So now that distribution, that cash flow that's coming in the future goes to pay off that $3,000 loan plus interest. And in that scenario, that would be something that you get diluted on your cash flow. I wouldn't say ROI, it's just really your cash flow.
And then isn't there also a potential for actual just dilution? So
yeah,
you can actually have a percentage. You could be cash called and not put that money in, and then per the operating agreement, you can actually have your percentage diluted a little bit, which would affect your ROI.
Correct, because again, if $3,000 is my cash call and Eric doesn't want to give me $3,000, Ken doesn't want to give, nobody wants to put in the $3,000 on my behalf, the company still needs my $3,000. They're going to have to go to the market and either issue more shares. And if they issue more shares, that means my ownership will get diluted. Instead of owning 2%, I might now own 1.5% or 1% or what have you. And so my ROI will start going down because there's more people out there to make distributions to.
Right. Okay, cool. So Jerry, let's do a couple more since we were had some technical issues. I want to give everybody their full hour.
Okay. Here's one from Dam Runner. If you're only able to rely on capital gains for income, what area of the real estate market would you focus on? Any suggestions? So,
if you're only able to rely on capital gains for income, so I guess that would probably be the opportunity zones, huh?
Yeah, yeah, it's kind of like a mix between a tax and a real estate question, right? If you're only relying on capital gains for income, so I guess what we're thinking about here is if you're, I don't know, I guess if you're looking at getting appreciation rather than having the cash flow on the property, then where are you looking? And I guess
You're wholesaling or flipping at that point.
What was that, Mauricio?
I say you're either wholesaling or flipping at that point, right? You're just trying to buy something, you're fixing it up, and then you're turning around and selling it for capital gain.
Yeah, but then if you're doing it for less than a year, though, then it would be ordinary. So you'd have to hold it for more than a year to get rid of it. But I guess to Ken's point, if you're looking for a long-term hold and expecting a lot of appreciation, there are the opportunity zones, which super quick overview is essentially this was something that was passed under the Tax Cuts and Jobs Act when Trump took office, and all the local governments were able to designate areas in their cities or towns or whatever, and those areas had certain criteria. Usually they were based on income thresholds, or basically they needed economic development. And so people are now incentivized, if you go and you build in those designated areas, or you substantially improve an existing building, which basically means putting twice as much into it in improvements as you paid for the property itself, then as long as you hold on to it for 10 years and sell before 2047, which is kind of an arbitrary date that they picked, then you don't pay any tax on it. So you don't even pay any capital gains tax, but you have to hold it for 10 years to get that benefit. And the only reason there's really a cap where they're saying you have to sell in 2047 is because they didn't want if you bought a property when you're 20, because you're doing seller financing, and you hold it until you're 70 or 80, you've got 50, 60 years of appreciation in there. So you've probably got a big tax bill that you'd be wiping out. So essentially the government said, okay, there's a cap to how long you can let this ride.
Yeah, but it is a good way to roll capital gain into something and defer it over another 10-year period. Okay, Jerry, one more. What do you got?
Just do a real quick, easy one, I guess. We've got...
Thank you, guys. This has been great. I appreciate you both.
Got it. Dennis asking a simple question about, can he deduct trip vacations to Florida if he went and looked at a few properties and submitted a few offers?
I'm going there tomorrow.
I just like Mauricio is planning to do a video on self-directed IRAs, I'm planning to do one on travel. So I'll keep it short, but look out for the video that'll hopefully come out soon. But essentially, it comes down to, was your trip primarily for business, or was it primarily for vacation? And so if you want to deduct expenses, you have to make the case that it was primarily for business. Now, that doesn't mean you can't deduct like direct costs to your business. So in other words, if you were going somewhere and it was mostly vacation, but then you had, say you're going on vacation for a week because you're going to go visit family or something, and while you were there, it just happens to be a good time to do this one thing that has a cost associated with it. Well, you could deduct that specific cost, but you wouldn't be able to deduct the plane fare or gas to get there or all the meals while you were there, because it was primarily personal. But if it's primarily business, so now, and potentially in the circumstance you're describing, your intention is to go visit either existing properties that you own and maybe look at some others, and that's the purpose of your trip. And it just so happens that, okay, I guess while I'm there, I'll spend an extra night to go see this concert, or whatever. Okay. Well, then you could deduct the plane flight there and the travel. You just couldn't deduct the extra hotel night that you stayed because you were going to see that concert, and you couldn't deduct the concert tickets because that was personal. But all the other expenses around the travel, you could deduct. So you basically have to make that distinction and that case that it was primarily for business to maximize it.
Okay. Awesome. And by the way, guys, I know there's a bunch of more questions in the queue here. We're definitely going to address them. We'll probably have to do them via email, but I want you to know that we are going to do that. And so thank you all, Mauricio, Eric. Thank you guys, as always. We're going to do this again next month. We'll put a date out soon so you guys can bring your questions each month. This is growing. We had a lot of people in the queue, and I appreciate everything. Jerry, Steve, thank you. You guys are the best. And we'll see you guys next time. And make sure that you're sending your questions in, because that is the whole point of this. So appreciate you guys doing that, and enjoy your weekend. We'll talk to you soon.